Ever wondered how a single street in New York City came to dominate the world's economy? From a wooden wall built by Dutch settlers to the epicenter of global finance, this is the epic story of Wall Street. Get ready to dive into the deals, the drama, and the dollars that shaped our modern world. Our story begins in the late 18th century, right after the American Revolutionary War. The newly formed United States was drowning in debt. To solve this crisis, Treasury Secretary Alexander Hamilton proposed a radical idea. The federal government would assume the state's debts and issue bonds to pay for them. This was a massive gamble. But where could people buy and sell these new government securities? Enter a group of 24 stocks. On May 17, 1792, they gathered under a buttonwood tree on a street named Wall Street. They signed a simple, two-sentence agreement known as the Buttonwood Agreement. This pact established the rules for trading stocks and created the foundation for what would eventually become the New York Stock Exchange. In these early days, Wall Street was a small, exclusive club. Trading was chaotic, conducted in coffee houses and on the street. But the seeds of a financial revolution had been planted. The nation's first bank, the Bank of New York, was established, and the concept of public investment began to take root. This wasn't just about trading paper. It was about funding America's future, building canals, railroads, and factories. The dream of American capitalism was being built, one trade at a time, on this very street. The 19th century saw Wall Street explode from a local market into a national powerhouse. This transformation was driven by titans of industry and finance, men whose names are still legendary today. Think Cornelius Vanderbilt, the railroad magnate, and Andrew Carnegie, the Steel King. But one figure stands above them all in the annals of Wall Street. John Pierpont. He wasn't just a banker. He was a kingmaker, a force of nature who could single-handedly stabilize or shake the entire American economy. Morgan's genius was in consolidation. He believed that competition was wasteful and inefficient, so he engineered massive mergers, creating industrial giants like U.S. Steel, the world's first billion-dollar corporation, and General Electric. This era, known as the Gilded Age, was a time of unprecedented wealth creation. Fortunes were made overnight. Palatial mansions, or cottages as they were modestly called, sprung up in Newport, Rhode Island, symbols of the immense riches being generated. But this wealth came at a price. The concentration of power in the hands of a few, like Morgan, led to accusations of monopolies and market manipulation. Critics called them robber barons, accusing them of crushing competition and exploiting workers to build their empires. The tension between explosive growth and the immense power wielded by these financial giants set the stage for the dramatic booms and busts that would define Wall Street's future. After the turmoil of World War I, America entered a decade of unprecedented prosperity and cultural dynamism, the Roaring '20s, and at the heart of it all was a booming Wall Street. It felt like the party would never end. New technologies like the radio and the automobile were changing lives, and a sense of optimism swept the nation. Everyone, it seemed, wanted a piece of the stock market action. Stories of secretaries and shoeshine boys getting rich quick filled the newspapers. A dangerous new practice called buying on margin became popular. This allowed ordinary people to buy stocks with just a small down payment, borrowing the rest from their broker. It was like buying a house with a 10% deposit, but for stocks. As long as the market went up, everyone was a genius. And for most of the decade, it did. The Dow Jones Industrial Average soared, reaching a peak in September 1929. The bubble was magnificent, but all bubbles eventually pop. On October 24th, 1929, a day that would be forever known as Black Thursday, the market began to plummet. Panic set in. A brief rally failed to hold, and the following Tuesday, October 29th, Black Tuesday, the market completely collapsed. Fortunes vanished in a matter of hours. The dream of easy money turned into a nightmare. The Great Crash of 1929 didn't just wipe out investors. It triggered a chain reaction that plunged the United States and the world into the Great Depression, the most severe economic downturn in modern history. The party was over, and the hangover would last for a decade. The devastation of the Great Depression forced a reckoning on Wall Street. The freewheeling, unregulated days were over in response to the crash. President Franklin D. Roosevelt's administration enacted sweeping reforms to rein in the financial industry and protect investors. The most significant of these was the Glass-Steagall Act of 1933, which separated commercial banking, the kind where you have your savings account, from investment banking, the riskier business of underwriting and trading securities. The Securities and Exchange Commission, the SEC, was also created to act as the market's watchdog, enforcing rules against fraud and manipulation. These changes fundamentally reshaped Wall Street. Then came World War II. The American economy roared back to life, transformed into the arsenal of democracy. After the war, the nation entered another period of sustained economic growth. The post-war boom created a new middle class, and for the first time, stock ownership became a mainstream aspiration for many American families. Mutual funds made it easier for ordinary people to invest in a diversified portfolio of stocks. This era saw Wall Street mature. It was less of a Wild West casino and more of a regulated, institutional marketplace. However, the human desire for a quick profit never truly disappears. The 1980s brought a new wave of financial scandals. The junk bond king Michael Milken and the insider trading case against Ivan Boesky, whose motto was famously "Greed is good," showed that even with regulations in place, the temptation to bend the rules for massive gain remained a powerful force on Wall Street. Welcome to the Wall Street of the 21st century. If JP Morgan were to walk onto the floor of the New York Stock Exchange today, he might not even recognize it. The loud, chaotic trading floors, once packed with shouting brokers in colorful jackets, are now eerily quiet. Why? The rise of the machines. Today, the vast majority of trading is done not by humans, but by computers. Complex algorithms execute millions of trades in fractions of a second, a practice known as high-frequency trading. These algorithms can analyze vast amounts of data and react to market news faster than any human ever could. This technological revolution has dramatically changed the skills needed to succeed on Wall Street. The hot jobs are no longer for smooth-talking salesmen, but for quantitative analysts with PhDs in physics, mathematics, and computer science, who can design and build these sophisticated trading models. This shift has raised profound questions. If machines are making all the decisions, what is the role of human judgment? And what about the jobs? The rise of automation and artificial intelligence has led to concerns about widespread job displacement for traders, analysts, and other financial professionals. The financial crisis of 2008, driven by complex financial instruments that few truly understood, served as a stark reminder that technology, while powerful, also introduces new and often hidden risks. Modern Wall Street is a battleground between human intuition and machine logic, a place where fortunes are won and lost at the speed of light. So, where does Wall Street go from here? The street that began under a buttonwood tree is now a global, interconnected network that never sleeps. Its influence extends far beyond Lower Manhattan, affecting everything from your retirement savings to the price of gas to the development of new technologies. The future of Wall Street will likely be defined by three major forces. First, technology, artificial intelligence, and machine learning will continue to get more sophisticated, making trading even faster and more complex. This will create incredible efficiencies, but also new challenges for regulators trying to keep up. Second, regulation. After every crisis, from 1929 to 2008, comes a new wave of rules. The ongoing debate is how to strike the right balance, how to protect the system from collapsing without stifling the innovation and risk-taking that fuel economic growth. And third, globalization. Financial markets are more interconnected than ever. A crisis in Asia can send shockwaves through New York in seconds. At the same time, new financial centers in places like Shanghai and Singapore are challenging Wall Street's long-held dominance. Despite all the changes, the scandals, the crashes, and the technological upheavals, Wall Street's core function remains the same as it was in 1792. Two-channel capital, to connect investors with ideas and to finance the future. Its story is a continuous cycle of innovation, greed, collapse, and reform. It is, in many ways, the story of capitalism, itself a powerful, chaotic, and endlessly fascinating engine of the modern world. Thank you so much for joining me on this journey through the history of Wall Street. It's a story with so many layers, and we've only just scratched the surface. If you found this fascinating, hit that like button and subscribe for more deep dives into the forces that shape our world. What part of Wall Street's history do you find most interesting? Let me know in the comments below. I'd love to hear your thoughts. Thanks again for watching, and I'll see you in the next video.